Welcome to this midweek look at markets. I'm pleased to have back on this segment Kevin Davitt, head of index options at the Nasdaq. Welcome, Kevin.
Thank you very much for having me back, Andrew. Good to see you.
Likewise, and looks like you're in the Chicago offices today at the Nasdaq. Is that right?
I am in the Chicago offices today.
Very good. Okay, for the sake of timing for the audience, we're recording Wednesday, May the 21st, 2025. In terms of background, the Walmart CEO has warned about passing some tariffs on to customers in the shape of higher prices, while Moody's has stripped the US of its last AAA rating status. Let's dive straight in. Kevin, are we stalling or are we staging for takeoff? The Qs fell by 27%, I think, February the 18th all-time high to April the 7th low. The rally through mid-May leaves the market within, I think, 4% of its peak. Is that a fait accompli? What are investors waiting for now?
Ooh, fait accompli. What a great term. The swings that you highlighted have certainly been wild. I think there's been a lot of coverage around or data showing how individual investors were actively buying the dip, to use the term, in April. Now, according to much of what I have seen, individuals were buying while systematic and institutional investors were largely reducing their equity exposure. Now, you mentioned at the outset Monday's activity following news over the weekend of Moody's downgrade of U.S. credit and their outlook. I think that example is arguably case in point. So what I mean there is, according to data from JP Morgan, there was something like $4 billion in retail buying just Monday morning, which apparently broke some old record.
Oh, wow.
As far as what investors are waiting for to answer the question, I don't have a great answer. I think if you asked a broad swath, you'd get a lot of really interesting but disparate feedback. I think it's also easy to kind of Monday morning quarterback a situation like this. Based on the stuff that I look at, the retail buying was largely concentrated in mega cap tech. You referenced the move in the Qs. A lot of those names had lagged year to date, which is interesting. And in general, those buys have been rewarded in some cases really significantly. The thing that I find interesting, maybe bigger picture and hints at your question as far as what people might be waiting for, has to do with expectations around employment and sentiment data generally. There is a gigantic disconnect between we typically term hard data, the quantifiable stuff like retail sales or CPI, and soft data, which is sentiment driven, and it's more kind of vibesy. The recent data out of the University of Michigan shows really bad consumer confidence, some of the highest concern over future employment since 2009, higher than 2020. So to the question, I think that some investors are waiting to see if they still have a job, which puts putting discretionary capital to work a more fraud sort of consideration. So long term, if we don't see a meaningful pickup in layoffs, I think the hard data remains decent to good, and Americans are really fabulous at finding ways to spend money.
Kevin, we're hearing from Walmart, as I mentioned, and other retailers about the impact of tariffs on prices and, as you mentioned, consumer sentiment and how it's likely to impact the corporate response. What are you hearing on, or what are you listening for from tech executives on the technology side?
Okay. So we have heard from Walmart, and we'll be hearing a lot this week from retailers, given that they're typically reporting earnings at the end of the season, so to speak. Generally speaking, they import much of what ends up on their shelves, and tariffs make those goods more expensive. Your audience knows that probably full well. And then the question becomes whether they end up eating some or all of those costs and it erodes margins, or whether historically what's been the case is that they typically pass those higher costs on to consumers. That's been well covered. Now, you're asking about the tech side of the ledger, in part probably because I care about the NASDAQ 100, and the index has historically been viewed as a tech benchmark. Now, to be perfectly fair, the exposure to tech is significant, and it's larger than that of the S&P 500, not by some order of magnitude. Now, I'll turn that around just a little bit. A company like Costco is a top 10 constituent in the NASDAQ 100. Amazon is top 5. Pepsi is top 20. You hopefully get my point here that it is a broader index than just tech. Okay. Now, you asked what I'm listening for from tech executives. And just to be abundantly clear, this is Kevin's response, not from NASDAQ. But I found it interesting that last week, Tim Cook, who your audience probably knows runs Apple, said the tariffs could cost them something in the neighborhood of $900 million this quarter. He's also made overtures about how they're shifting some production from China to India. NVIDIA is another example. And in my opinion, probably a decent representation of what I expect to see from big tech firms. They have significant influence in Washington, D.C. and elsewhere. And there have been a bunch of carve-outs for things like GPUs and other critically important technologies. In short, what I expect to hear is that tariffs are a tax. But what I expect to see behind the scenes are efforts to lobby and changes to allow them to continue operating at scale. And that, again, is just my take based on what I follow.
Tariffs, on the one hand, may have brought down the pace of economic growth at the margin because they've been very disruptive. But on the technology side, what do you feel is going to cause the next wave of a market rally? What do we have to wait for?
Okay, so on a question like that, I'm of two minds. Again, just my opinion. Big picture, really big, broad picture. I think that technology will continue to lead markets both higher and lower. I think it's arguably the story of this century. And I think if you remember some historical webinars we've done, I do think through the lens of broader history and think about the agricultural revolution, industrial revolution. And we're arguably in potentially the early stages of an information revolution. So tech has been leading and in some cases lagging for 2 decades. And I don't think that's likely to be interrupted soon. It pushes productivity, it increases margins, it's worked, but there are cycles. In the near term, what I think could catalyze another leg of a rally is systematic flows and institutions piling back in or chasing. So in your first question, we talked about how retail had been actively buying. When I talk about systematic, I'm thinking about things like vol control funds. They are rules-based. And generally speaking, they scale up equity exposure when volatility comes in and vice versa. So they were scaling down into that big swell of volatility. Now, if you have a 1-month look back on vol, that should continue to fall, whether you're looking at the S&Ps or the NASDAQ 100, given the period with the most significant daily moves was right around 30 days ago. So those will fall out of the calculation, and we would expect realized vol measures to decline, and that generally pushes equity allocations higher. So to date, NDX 1-month vol has fallen from about 50 to 40, and absent some real big swings, I would expect it to continue to fall. The other potential catalyst is the fact that, like I mentioned, individuals were buying, institutions were not, and if they feel compelled to get in, that they could be missing that next leg, those sorts of big dollar allocations can matter. When I think about my personal account and the trading that I do, I am more active in there, not thinking quite as big picture. And I would happen to be skewed a bit more for downside at the moment, but that's a different look, as tactical as opposed to strategic. And that, again, is just my opinion, but that's the thing that makes markets wonderful.
Kevin, we'll let you get back to it. Thank you so much for joining me today.
Thanks for having me, Andrew.
All right. And to the audience, thanks for listening. And remember, subscribe wherever you get your podcast from.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Any discussion or mention of an ETF is not to be construed as recommendation, promotion, or solicitation. All investors should review and consider associated investment risks, charges, and expenses of the investment company or fund prior to investing. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice.